Hi, everyone. I welcome you all to the discussion on this topic, framework for the preparation and presentation of financial friends reporting. The syllabus majorly is around the IND-AS, right, or the new standards issued by the ICAI. So before we start learning those IND-AS, let's take a step back and try to understand that what is the basis on which these IND-AS are prepared, right? What is the basis on which these IND-AS are prepared, and why probably we need that basis to really understand those IND-AS in a practical perspective. Okay, and somewhere we also want to address this, that if the IND-AS are lacking some information, and we also want to talk briefly in terms of why would they lack some information, these these foundations or these framework help us arrive at some conclusion so that we can apply those concepts in practice, and of course do the, let's say, accounting transactions for the business or a client of ours where we need to do that. Okay, imagine, for example, if I say I'm talking about a term called as principle based. Okay, what is the principle based? We have heard this term before, I'm sure, about the AS or the accounting standards that we talked about. The principle based simply says that you don't have a detailed text to cover everything. And realistically, it may not be desirable or it may not be possible to have a clear solution written in black and white or written in form of a text wherein you are trying to arrive at the clarification on some accounting aspects, right? So somewhere you want to make use of a judgment. Okay, and that is what is basically the idea of the IND-AS as well. There's no clear answer sometimes available to us when we are trying to address or assess an accounting scenario, which means that you need a professional judgment to be able to arrive at a conclusion. Now, to ensure that this judgment is made on a logical basis, right? You need some foundation or some principle around which you want to arrive at the judgment. And that is where the framework tries to help us. Okay. Now, the one comfort that you want to always carry, that this particular chapter is entirely on the basis of or on, is entirely based on what we have already done at our CA intermediate level, wherein we did the understanding of the same chapter with the same name, okay, in the paper one of accounting, right? So we are not very differently talking on that perspective. So in a way, it could be a revisit to what we have done already. Okay, so be very comfortable. But yes, we need to talk about that in detail because we're going to use this information very diligently when we study IND-AS, in the going forward lectures. All right. So what exactly is this framework trying to address? Okay, the one thing that we want to talk about here is, for example, it gives us the basis of applying IND-AS in practice, right? Since there is a professional judgment involved, somewhere these framework would help us evaluate that in terms of how to apply those IND-AS in practice. The other aspect that you are also trying to address here is that there are different uses of financial statements, and they could be from different industry as well. Okay, so how do you make sure that they all understand the financial statements in the spirit? Okay, we don't expect, for example, a non-accountant, let's say if it were a doctor, to be knowing accounting, and or we are expected to teach accounting by giving all that information. No, we don't expect to do that. But at the same, get in who we assume are capable information are capable of understanding these position and performance. Decision involved, they would, let's say, want to goods if these were, let's say, the suppliers of the goods or services, or these could be, providers of finance. They would want to take a decision whether they should be lending more money to the business or not. The customers may be interested in knowing, for example, establish also some these different users and the different sets of needs that they have got. Okay. Also, the framework interested in knowing, for example, also some the basis of measures, elements of finance. Okay. Financial statements, I might want to, let's say, bring into the context. What is the meaning of an asset? What's the meaning of a liability? What is meant by equity, for example, and many such transactions, many such elements per se. Okay. Now we would also want to kind of probably understand, this thing in detail. And then we talk about, of course, the basis of measurement. Should I use the cost, something that we have heard of, historical cost method, or should I use the fair value, which is the current cost, for example? There is also a concept of, and you would hear it more often when you study the different indices, something called as a present value concept. Okay, and there are a few more, basis of measurement available. So the argument that comes in, what measurement basis is appropriate, that although would be defined by the different indices, but what bases are available is governed by the framework. Okay. And not just this, it also talks about qualitative characteristics of financial statements. And somewhere it addresses, of course, this aspect of the different users have different needs. So a standardization, appropriate benchmarking in terms of, providing relevant information, providing complete information, ensuring that there is no bias, right? There is subjectivity, there is no subjectivity involved. There is a comparability aspect involved. So everything has to be, brought into the context when you look at the qualitative attributes, right? Also, somewhere this framework addresses the need of the way, for example, capital should be understood, the capital that is invested into the business, right? I mean, let's appreciate the fact that when anybody starts a business, the growth is important, right? So people assess how, but then are we only looking at a financial parameter around that? Somewhere the framework says it is not only about financial growth, right? It's not only about a financial capital maintenance. It is also to do with a physical capital maintenance aspect. I mean, in a very simpler term, we are trying to address that. If, for example, I started with a business with, let's say, one set of a machine with a particular capacity, and after the year, for example, this one machine has turned into, let's say, 4 machines, right? Even that could be an important aspect to consider the growth. That could be a measure to value or, determine how far has the entity grown, right? Which may not always be reflected through the financial capital perspective. Okay, so these are all different aspects that we intend to spend some time on, right? While I acknowledge the fact that the level, but we still want to kind of do a refresher of that aspect of What is a framework, or something we refer to as a conceptual framework, right? In preparation and presentation of the financial statements. Okay, it would be probably even more important in today's context when we, of course, read that, in the framework of, or in the gamut of Ind AS. Let's try to take a small example around it. Okay, I'm saying, let's try to define the meaning of the word asset. Now, what is an asset to you? We say something that is expected to offer benefits in future, something which is controlled by the entity, right? So these could be two attributes for anything to be considered as an asset. Okay, so if I were to really look at it from the framework's context, right, we need to make sure that any element which meets these two criteria would be necessarily called an asset in the finance. Okay, a specific example to clarify why probably the framework is helping when we are doing accounting transactions under different days. Okay, let's say there is a company X, which is an exporter, right, of services. So let's say it's an Indian company, right? So it sells services worth $10 million to customers outside India. It could be, let's say, an IT company, for example. Okay. Now, there is a receivable that this company has got. The $10 million worth of sales that it has made, and the money is expected to come. Let's say the credit period is 6 months. Okay. Now, essentially, there is a risk that this company is taking. Okay. The risk is that, well, I have made a sale of $10 million. So let's say, for the sake of argument, right, today's rate is INR 70 rupees per dollar. Right? So I would book my revenue or sales basis that. Right? Now this 10 million, which is basically 1 crore, which simply makes my sales at 70 crore rupees, and my receivables is also 70 crores. Now, the inherent risk that this transaction has got, that in 6 months' time, right, what if the exchange rate is going unfavorable? Okay, so what the company does, it gets into a hedging, right, a basic contract between this company and, let's say, a bank, where it agrees to sell those dollars at a rate of, let's say, 72 rupees per dollar, which effectively means that no matter the exchange rate at 6 months' time from now, the company will be able to sell these $10 million at 72 rupees to the bank, and would collect 72 crore rupees there. Okay. Let us say, for the sake of argument, 3 months later, these dollars could have been sold, let's say, at the rate of rupees 65 per dollar. Okay. Now you have already got into a contract where you would be selling these $10 million to that banker at 72 rupees per dollar. And the bank has agreed. So the contract exists. Okay. So effectively, the value of the contract to you is 72 crore rupees in terms of the collections, or in terms of the recoverability. Had you not got into the contract, so contract is already in place. Had you not got into the contract, the amount that you would have received otherwise would have been 65 crore rupees. Right? 3 months later, the value of the contract is 65 crores. But since you got into the contract already, which is worth 72 crore rupees, although notionally, we may say in a very simplistic term, we may say the contract is worth 7 crore rupees. Okay. Now, when I say this contract is worth 7 crore rupees, have I received that money? The answer is no. Am I expecting to close this contract today and settle it? The answer is again no. But by virtue of the fact that this contract would have been worth only 65, which I have logged in for 72, right? Because there is a contract, the company X has control. And with this value, it is also expected to offer benefits, which suggests to me that I need to recognize this asset of 7 crores in my books. Okay. That is something where the framework is used, is applied to really, understand or talk about what could be the meaning of an asset, like in this example. All right. So we will be seeing a lot of such examples, and these are the aspects which we use the framework, the conceptual framework, to arrive at a conclusion. Okay. In your examination also, very importantly, if you are very thorough with what is the meaning of an asset, what is the meaning of a liability, what is the meaning of revenue, what is the meaning of income, what is the meaning of an expense, for example, these are different elements. You would be in a very good position, you'd be in a very comfortable zone to be able to answer those questions in the examination standpoint. So it's not just a practical perspective which this particular topic covers, but also on the examination parameter. This could be a very interesting and important topic to discuss, right? So, and we're going to use this entire stuff in different accounting, different Ind AS, not the word accounting, and I want to use this like that, right? So we'll be using this guiding principle with the help of the conceptual framework to arrive at an answer there. Okay, let's take another question here, another aspect here, just to quickly appreciate why probably this thing could be really critical. Okay, I would want you to think of what could be, for example, meaning of a liability to your mind. Okay, what is a liability, by the way, you think of? I would say there has to be a present obligation and there is an expected future outflow, right? So the entity has a present obligation, and at the same time, there is an expectation that something has to be paid. There's an expected future outflow as well, right? Think about it like this. Let's say there is a company AB, okay, that enters into a lease arrangement, right? Where it, for example, let's say, takes a machine on lease for 5 years. Let's say the life of the machine is 50 years. So you're just hiring it for, let's say, 5 years. Okay. Now, importantly, when you look at this arrangement, you might want to use or think about it like, it's a usual example of an operating lease. Okay. Wherein company AB is supposed to pay rentals and you would be charging those expenses in the books, and that's the way the simplest form of accounting comes in. But now what we want to really look at, again, the fundamental aspect involved in this definition of liability. Okay, so think about it like this. There's a contract for 5 years which suggests that you are obliged to pay for the use of the machine. Okay. You are presently obliged by virtue of the contract again. You're presently obliged to pay for the use of the machine, which also, by the way, results in expected future outflow. Okay. What does it signify? It signifies that the definition of the word liability is met in the same case, in this scenario. Okay. And when the definition is met, you cannot skip it now. You have to recognize a liability in the books, right? How do we measure it? How do we calculate that? Let's not worry about it. We will be spending time on the particular Ind AS. For example, in this case, I would refer to Ind AS 116 to answer that question, which is leases, which is the newest or the most recent accounting standard. Okay. But the fact is that the newer accounting standards, they are being prepared, taking the guidance from the conceptual framework. Okay. We are not worried about here. Believe me, we are not worried about at this point in time in terms of how to do the accounting for these things. We are simply talking about, that there are the basic elements of financial statements, namely assets, liabilities, equity, revenue, income, expenses. We just need to appreciate it more in terms of, how do we understand those definitions in a more appropriate, logical, practical manner. And that's what is the expectation of this conceptual framework. Okay, just to recap, if I really take you back there, the framework for the preparation and presentation of financial statements would cover that, yes, there is a basis of applying those Ind AS in practice because the standards are indeed principle-based accounting standards, right? There are different users of financial statements with different industries and different needs. So they need to have, the financial statements need to have some, qualitative attributes, qualitative characteristics so that the people can appreciate how are these prepared and how are the information presented. Okay. Likewise, we talk about the basis of measurement. Different bases are available. We have heard of historical cost in the past. We have heard of market value in the past. We have heard of net realizable value. Remember AS2, inventories, right? Now, with the Ind AS framework, there is a common phrase of present value also being used. So we'll be hearing this more often. So all these measurement criteria are available and they're all discussed in the conceptual framework itself. And finally, as I said, that the capital, the measurement of the growth of the business, the growth of the capital is not only taken, for example, by virtue of a financial parameter, wherein talk about the return on investment and the profitability, etc. But you're also talking about, for example, the physical capital there, right? The capacity of the company, from X number of units, for example, it used to produce with the help of set of a equipment, which has expanded from an X unit to, let's say, 3X or 4X units. So even that is a format or an understanding that we want to build with the help of the conceptual framework, right? It's a very straightforward theoretical concept. Let's not get into that further. But when we discuss these aspects, we would be able to appreciate, and we're going to use that very extensively, right? When we are discussing the Ind AS over the period of time. All right. So that's something which I wanted to cover as an introductory phase. So all we would want to talk about is something that we have discussed already. What is meant by the framework and its objective? Who are the users of financial statements? What are the objectives and underlying assumptions when you're preparing those financial statements? Why do you prepare? What is the objective? And what do we need to assume when we're preparing the financial statements? We have heard of these terms called as accrual and going concern. You're going to just use those here again. So it's a revisit of, as I was saying before, it's a revisit of what we already know, right? And the good part is that they remain exactly the same. They remain all, more or less the same, whether we are talking in the context of AS, which we have done in the intermediate level, or we are talking about Ind AS, which we want to talk about at CA final level as well, right? What are the concepts and the definition on which the Ind AS are based? Again, those definitions of assets, liabilities, etc. would come in picture. We talked about also the forms of capital, where we said that there could be a financial capital maintenance, or there could be a physical capital maintenance as well. Okay. From an examination standpoint, well, it's just being tested now because the old syllabus didn't really talk about that. The new syllabus has tested that once in May 2019 for 5 marks, and this is going to be used, by the way, in terms of its applicability across different standards. Again, you would be reminded from time to time to know what could be an asset for you or what could be a liability, and the different terms that we will be discussing in the due course. All right. What we want to do, of course, is look at this framework, objectives, underlying assumptions in this particular section. Right. Thank you very much.